Welcome to the deep dive. Today we're really digging into Eternal's Q1 FY26 results. And this shareholder letter, it's more than just numbers, right? It feels like a look inside a company that's, well, changing fast.
Yeah.
They seem to be rethinking everything from leadership to how quickly you get your groceries. It's quite a story in the digital space. So our mission here is to pull out the key insights for you from this direct look at their strategy, their challenges, and what's next.
Exactly. And we'll try to frame it for you, not just the financials, but the big strategic moves, the thinking behind their growth for the quarter ending June 30, 2025. Before we jump in, though, maybe let's just quickly clarify a few terms we'll be using. So net order value, NOV,
Yep.
that's just the total value of orders across food delivery, quick commerce, and their going out business. Simple enough. Then adjusted revenue, basically their operating revenue plus delivery and platform fees they collect. And adjusted EBITDA, that's their core earnings figure, EBITDA, but adjusted for things like stock compensation and rent. Just helps compare apples to apples.
Perfect.
Okay.
All right, let's unpack this then. Starting with the Q1 FY26 financials, what's the big picture look like for their main business?
Well, the overall performance, particularly in the consumer-facing parts, shows some really significant growth. We're talking 55% year over year and 16% quarter-over-quarter growth in that NOV figure. It hit INR 20,183 crore. But the real, I think, pivotal moment hidden in there. Q1 FY26 was the first time ever that quick commerce NOV was actually higher than food delivery NOV for the whole quarter.
Wow, okay, that is a big shift. Changes the whole story about where their main growth is coming from now, doesn't it? What does that mean, practically speaking?
It's huge. I mean, think about it. Their B2C businesses combined are now running at nearly a $10 million annualized NOV rate, and quick commerce is almost half of that. It's a fundamental rebalancing. Now, switching gears slightly, their B2B side, Hyperpure, revenue there grew strongly, 89% YoY, but, and this is interesting, the letter actually flags expected degrowth in the coming quarters.
That seems counterintuitive. Why would a business growing that fast suddenly expect to shrink?
Yeah, it ties into a bigger strategic decision we'll get into later. It's about their plan to own inventory in quick commerce. See, Hyperpure sold a lot to those quick commerce sellers. As Eternal takes over inventory directly, that specific B2B revenue naturally drops off. So it's more of an internal shuffle, not Hyperpure failing.
Okay, got it.
Yeah.
So looking at the total picture, consolidated adjusted revenue is up 67% YoY, 22% QoQ, hitting INR 7,563 crore. And they've kept that 50% plus growth streak going for, 11 quarters now. Pretty impressive consistency. But profitability, that's where it gets a bit more complicated. Consolidated Adjusted EBITDA actually went down 42% YoY to INR 172 crore. How are they juggling this, super fast growth with actually making money, especially with EBITDA falling?
That's the million-dollar question, isn't it? Or maybe billion-dollar in their case. The EBITDA drop is mainly down to just pouring money into quick commerce and also their going out business, big investments. But it was partly cushioned because the food delivery business improved its margin. It went up to 5.0% adjusted EBITDA margin from 3.9% a year ago. So you've got the mature core kind of funding the newer, faster-growing parts. How long can that last, though? That's the balancing act.
And maybe part of the answer lies in something really unique, and to talk to this rotational leadership idea. That's not typical corporate structure.
No, it's definitely not. It's a pretty fascinating model, actually. Basically, CEO roles within their businesses have term limits, usually about 2 years. And the thinking behind it is, well, several things. Structural agility, keeping energy high, fighting complacency. They think it speeds things up, brings in different leadership styles, and makes the organization stronger, less reliant on any one person. It's also about handling succession better and pushing decision-making down.
Okay, but building a system over individuals, does that have downsides? Like, could it mean less long-term accountability? Or maybe it's harder to build deep expertise in one area if the leader changes every couple of years.
Yeah, those are fair points. And they sort of acknowledge that. They say it's not for everyone. It works best, they think, when the culture already values systems, when you've got product market fit, when the market's changing fast anyway, and when you really want to groom leaders. But they explicitly say it's not good for early stage startups or companies just trying to survive. So it implies the core business is stable enough to handle this kind of, experimentation at the top. They seem to believe the agility benefits outweigh those risks for them.
Which kind of leads us to the new food delivery head, Aditya Mangla. It feels significant that he's the first non-founder product engineering type to lead it in, 17 years?
Absolutely. Fits right into that idea of developing tech-first leaders. Now, if we look at food delivery performance itself, the NOV growth did slow a bit, down to 13% YoY from 14%.
Is that a worry? Or just a blip? What's the outlook?
They seem pretty confident it's bottomed out now, after that slowdown late last year. For the full year FY26, they're aiming for north of 15% YoY growth, maybe trending towards 20% in FY27. That little dip in Q1, they put it down to more restaurant discounts happening quarter over quarter. And speaking of metrics, they mentioned going forward, they'll only report NOV for B2C. They feel it's just a cleaner growth measure.
Right. But here's something interesting. Food delivery margins went up year over year, but down quarter over quarter. Why the dip compared to last quarter?
That's mostly seasonality. Happens every Q1, apparently. You get festivals, bad weather hitting delivery partner availability, summer heat, rain starting. In the past, maybe other improvements masked it, but now that the margins are pretty mature, you see these seasonal dips more clearly.
So just the time of year.
Uh,
But you'd think a mature business could smooth that out better by now? Or is it just that they're running so lean, there's less buffer for those hits?
Probably more the latter. They're pretty optimized. Long term, they still see some room for margins to creep up, but right now the focus is more on investing for growth again, while keeping margins, roughly in that 5% of NOV ballpark. As for new competitors, their view is basically bring it on. They think new ideas make them stronger, forces them to adapt. They don't see any major threat right now that they can't handle or out-innovate.
That's a bold stance. I mean, history's full of dominant players getting sideswiped. Is it just confidence, or is there something specific in their defense mechanism that maybe isn't fully spelled out?
I think it goes back to that culture. We'll talk more about that constant dissatisfaction, always problem solving. It's not just defense, it's trying to be the disruption themselves. They seem built for change, so a threat is just another problem to solve, another way to get better.
Okay, let's switch tracks then. The going out business district, what's catching your eye there?
Oh, district, yeah. The potential they see there is pretty exciting. Right now, it's got about 2 million monthly active customers. They transact roughly twice a month. And the average order value, the NAOV, is high over INR 1,700. It's smaller than the others, but growing nicely, like 30% plus YoY if you compare like for like.
And that revenue per order over INR 160, that's way higher than food or quick commerce, suggests a very different kind of spending, right?
Absolutely. It's a premium play. They're positioning District as this unique single platform in India for all sorts of going out things, dining, movies, sports, concerts, aimed squarely at the top end of the market. And the big picture ambition. They think this could become a $3 billion annual NOV business, throwing off $150 million in adjusted EBITDA within about 5 years. That'd be huge.
Okay, now on to Blinkit. Quick commerce. This seems to be where the real action is, the intense focus. What were the highlights last quarter?
Blinkit is just full throttle expansion. Added 243 net new stores in Q1 alone. That brings them to 1,544 stores total, and they're still gunning for 2,000 by the end of this year, December 2025, plus adding warehouse space. And the growth numbers reflect that. 127% YoY growth in NOV, driven mostly by just incredible customer growth, up 123% YoY. They went from 7.6 million monthly customers a year ago to 16.9 million now.
16.9 million. That's staggering growth. But all those new stores, that expansion, what's it doing to the bottom line? Are they just buying market share with losses?
Well, here's the really interesting part. The profitability is actually improving despite all that spending. Margins got better, moving to minimal 1.8% of NOV from negative 2.4% the previous quarter, and that's with all the costs of new stores and the seasonal headwinds we talked about. Getting to negative 1.8% while adding stores that fast, it suggests the older stores are becoming quite profitable. It shows the model can work economically, which isn't always a given in this space globally. They're saying long-term profitability isn't a worry. Some cities are already doing over 2.5% adjusted EBITDA margins. So near term, it looks like the percentage margins have kind of found their floor. If competition stays about the same, margins should improve, and the actual cash loss should start shrinking as stores mature. But they do warn, it might not be a straight line upwards. There will be bumps. The market's huge, competition's fierce, but they're absolutely committed to not losing ground here.
Makes sense. What about the smaller cities? Is quick commerce profitable there? Or are the economics tougher with maybe lower order values?
The early signs are actually quite positive for smaller cities, too. The average order value isn't that much lower, maybe about 10% less than big cities. And when you factor in lower operating costs rent, labor the path to good margins looks pretty attractive there as well.
So they hit 2,000 stores by December. Is that the limit? Or is there still runway beyond that? Are any areas getting saturated?
Oh, definitely not saturated, they say. Even in cities where they have lots of stores, like Delhi, NOV is still growing over 70% year over year. They already see a path to 3,000 stores. They'll likely talk more about timelines for that once they cross the 2,000 mark.
Okay, this is maybe the core question then. Why does Blinkit seem to be scaling faster, and maybe with better economics, than some competitors, both here and abroad? What's the magic ingredient?
Well, they say it's about keeping it simple and just obsessing over the customer promise, which means solving two really hard problems at once. One, building a whole retail operation with a super fast, just-in-time supply chain. And two, layering on the internet and logistics piece, like food delivery. They prioritize customer value like this. Speed first, then assortment, then support, and only then price. And apparently, this approach lets them make money on basically all groups of customers. Even brand new ones are breaking even on a contribution basis right from the first month. And there's this cultural insight they shared, which I found really telling. They cultivate what they call a dissatisfied culture. Teams hardly ever celebrate wins. They keep a low profile. They genuinely seem to believe they're only 1% done. So the focus is just constantly on the next problem to solve for the customer, not patting themselves on the back.
Huh. Dissatisfied culture. So less celebrating milestones, more back to fixing things. That's certainly different from the usual tech narrative.
Yeah.
How does that actually drive innovation?
Well, if you always think you're only 1% done, you're never resting, right? You're always searching for the next inefficiency, the next customer pain point. It seems to fuel this constant cycle of improvement, driven by never quite being satisfied.
Okay, let's shift to a major structural change. Eternal becoming an Indian-owned and controlled company, IOCC, and what that specifically enables for a quick commerce.
Right. So the foreign ownership cap, 49.5%, is locked in. They're currently around 43%. And this IOCC status is key because it allows them to make this big switch in quick commerce. Over the next, say, 2 or 3 quarters, they're moving from being a marketplace to actually owning the inventory themselves.
Right, so moving from marketplace to inventory owner, what does that really mean day to day for us as customers and for how Eternal operates, beyond just better margins or more assortment control?
It's a fundamental change. As a marketplace, they were like the connector linking sellers to buyers, like with restaurants. Owning inventory means they become the retailer. They buy the goods, they hold the stock, they set the prices, they manage the quality directly for us. Potentially a more consistent experience, maybe better availability for them. Way more control, yes, but also way more complexity and risk. They own the stock if it doesn't sell. And the financial ripple effects are significant. Quick commerce revenue will look much bigger, closer to the NOV number. But Hyperpure's revenue will drop because it loses those internal sales to the quick commerce arm. And net working capital, NWC, the money tied up in operations, will shoot up for quick commerce because they're holding all that stock. It'll go down for Hyperpure, though. They did mention, interestingly, that about 3% of NRV in Q1 was already from inventory they owned. Expect that percentage to climb fast.
Okay, so holding inventory costs money. What kind of return on capital employed, ROCE, do they expect from quick commerce once they fully own the inventory? And why should we care about that number?
They're targeting at least 40% ROCE, assuming they hit that 5-6% adjusted EBITDA margin goal. Now, why care? Because ROCE tells you how efficiently they're using the money they invest. A 40% ROCE means for every 100 rupees invested in stores, warehouses, inventory, they expect to get 40 rupees back in profit each year. In a business that needs a lot of capital like this one, proving you can generate strong returns is critical for showing it's a sustainable, profitable model long term. It shows discipline.
Got it. Shifting to the others category in their results, the loss there got bigger. What's driving that?
Yeah, the main driver there is investment in Bistro. That's their 10-minute food delivery service. And the key difference here is Bistro isn't just faster delivery from existing restaurants. Eternal is actually building and running its own kitchens. Think dark kitchens, specifically designed for making and delivering certain types of meals super fast. They've got 38 running now in Delhi NCR and Bangalore. The idea with Bistro is to capture demand that Zomato maybe doesn't serve well, like really good quality but low-cost meals or quick snacks delivered in 10 minutes. They say it's not really eating into the main Zomato business. Customer uptake looks strong, but yeah, now they need to figure out how to make it profitable.
And besides Bistro, they're also putting money into something called Nugget and this new initiative, Greening India, about INR 150 crore budgeted loss funding across all 3 this year. What's Greening India about? Sounds different.
It is different. Greening India is described as a first-of-its-kind large-scale agroforestry project for them in India. The plan this financial year, FY26, is ambitious. Plant over 2.5 million trees across 10,000 acres, partnering with thousands of farmers.
Wow, 2.5 million trees. That's got to have some serious environmental impact, but also financial angles, too. It's not just planting trees for goodwill.
Exactly. Environmentally, they estimate those trees could eventually remove 1.5 million tons of CO2 over 30 years. Huge. Financially, they expect the value of the carbon removal credits they'll get from internationally recognized registries will be worth multiple times their investment. They're budgeting about INR 30 crore for it in FY26. Plus, they can potentially use these credits themselves towards their own net zero goal for 2033. So it's ecology and economics working together. And just quickly on cash, their balance went up slightly, ending Q1 at INR 18,857 crore. Capex was about INR 370 crore, mostly billing out those quick commerce stores and warehouses. And the working capital changes, partly from that inventory ship starting, were managed.
Okay, so bringing it all together, what's the big takeaway for you, our listener, trying to understand Eternal right now?
I think the picture is one of really aggressive growth, definitely, but also a significant strategic change happening all at once. You've got rotational leadership shaking things up internally. You've got this massive shift to inventory ownership and quick commerce. And at the same time, they're funding potentially disruptive new bets like Bistro, plus this major environmental project, Greening India. It's a company firing on many cylinders, playing a very long game.
Yeah, and underpinning it all seems to be this combination of sharp operational execution, making really bold strategic calls,
Yeah.
and that very distinct dissatisfied culture driving things forward.
Which leaves us with maybe a final thought for you to chew on. How does a company effectively balance that relentless pressure for speed, for growth, for innovation, with the need for long-term financial health, building resilient structures, and even making these broader societal contributions, especially when its own culture seems wired for constant problem solving, maybe not so much for celebrating the wins along the way? What does that kind of culture mean for innovation? And, well, is it sustainable forever?
Definitely a lot to consider there. Thank you for joining us on this deep dive today.